Good evening, everyone. My name is Kiana Danial, and we are going to have a webinar on global economic overview today. We are going to wait a little bit for more people to show up. In the meantime, I would like to cover today's agenda. You can see the screen. Today we are going to talk about the economies of major currencies, including the US, Eurozone, UK, Canada, Australia, Switzerland, and if we have time, we're also going to cover Japan. All right, so today we are going to start with an economic review on Canada because we just had Bank of Canada's Governor Polis speech out. Stephen Polis gave a speech over at oil-rich Alberta on Monday, wherein he talked about riding the commodity cycles. Hi, Hubert. Can everybody hear me, by the way? Please type in a Y for yes if everyone can hear me. All right. So, yeah, back to Governor Stevens' speech. His speech was essentially sort of a pep talk to the people of Alberta who have been hit the hardest by falling oil prices, and they didn't really have anything of great value for well-informed veteran forex traders, which is probably why the Canadian dollar, the loonies forex price action, wasn't affected as much. But his speech did give a good summary on how the Canadian economy got to where it is now. And well, basically, I mean, by that, I mean in a state of a recession. And that could be the reason why we saw the falls in the loonie today. If you don't know what the Canadian economy has been going through, well, basically, according to Business Insider, and I'm quoting right now, Canada is officially in recession. The economy shrank in the second quarter of 2015, making it the second quarterly contraction in a row. Gross domestic product in Canada fell at a 0.5% annual rate in the quarter. In the first quarter, the economy shrank by 0.8%, and Statistics Canada, the National Statistics Agency, revised the contraction in the first quarter to 0.8% from 0.6%. Business investment fell by 7.9% during this quarter after a 10.9% drop in the previous quarter. This was actually according to Bloomberg. GDP was up 0.5% in June, but not enough to counteract the declines in April and May. Last month, the country's statistics agency released GDP data that showed the Canadian economy shrank by 0.2% in May. It was worse than expectations of 0% growth, and it was the fifth consecutive month the economy contracted. Weighing on the economy that month were the manufacturing and mining, oil, and gas extraction sectors. It is good to know that Canada is the U.S. largest trading partner. A lot of people mistake that with China, but Canada is, especially when it comes to oil. And oil and loonie definitely have a positive relationship to each other. The drop in oil prices that began more than a year ago has been hard on the net oil exporting nation. They highly depend on oil exportation. That is the reason why the more drops we see in oil, the more drops we see in the Canadian currency, and the worse gets the Canadian economy. Crude oil prices fell below $40 a barrel last week to post and that was a post-financial crisis low of a 38%, $38 a barrel. Oil services companies like Schlumberger are cutting jobs, and Alberta, Canada's main oil producing province, saw its unemployment rate jump from 5.5% to 5.9% in June. The effect of falling commodities prices on the Canadian economy is not going to let up anytime soon, according to BNP Paribas analyst Derek Lindsay. The Bank of Canada cut interest rates in July, which actually resulted in a huge, massive drops in Canadian dollar, and they could do so again this month. That is a prediction of Derek Lindsay from BNP Paribas. In a note on Tuesday, Lindsay said that we expect further easing ahead because investment and exports remain in contractionary territory, and the economy remains vulnerable to a correction in housing and a pullback in spending due to high levels of household debt. And right now, the Canadian dollar, we are going to check out our platform later, but it's good to know that the Canadian dollar, also known as loonie, is now at its lowest since 2014. It's trading at around 133 per US dollar. Today it went back up to 133. I was bullish the dollar CAD, and we did make money on that. So that is something that you would want to know. The lower the Canadian dollar gets, the higher the dollar CAD pair gets, and that is a bullish signal for forex traders. I want to take a minute and welcome all the peeps who just joined us to the webinar. Welcome and thank you for joining. Please do take notes during the our webinar, and if you have a question, simply write your question down in the GoToMeetings question section. We are going to cover the economic overview of the US, Eurozone, UK, Canada, Australia, Switzerland, and hopefully Japan, time permitting. We are available at Orbex Trader Library. My videos are up twice a week, Tuesdays and Thursdays, and I talk about the upcoming economic events as well as my current trading positions in the market. So definitely don't forget to tune in. Myself, I'm Kiana Danial. You probably know me from my book, Invest Diva's Guide to Making Money in Forex. We are having a new book signing in Stamford, Connecticut this October 10th on a Saturday. So if you are in the U.S. territory, definitely feel free to join us. If you want to learn more about my activities and my positionings, definitely sign up at investiva.com for our daily market updates on my personal trading experience and my personal trading journey. Back to Canada. We were talking about Paul's speech yesterday. So we basically covered that Canada is currently in a recession. And in Paul's own words, a large and persistent increase in demand leads to sustained upward pressure on resource prices over a number of years. And by this is trying to explain the commodity cycle. As you may know, the Canadian currency is a commodity currency, and that's why I'm giving you this update. The higher prices act as an incentive to boost supply, and companies act by, for example, investing in new capacity and finding methods to increase efficiency The higher output generates by those investments combined with stabilizing demand to bring about a period of downward pressure on prices. Faced with lower prices, companies may scale back investment and production. Ultimately, the lower prices will encourage demand, and the reduced investment will crimp future supply, leading to higher prices. And producers will ride the price cycle all over again. So this is basically format if you want, if you prefer a list of format. Number one is demand increases. Number two is price increases due to higher demand. Number four is profit. The actual list, to get it a little bit longer and more detailed, the number one in the cycle is demand for resources increase. Number two, price increases due to higher demand. Number three, companies exploit higher prices by increasing productivity. Number four, higher supply due to higher production level leads to lower prices. The stage five, lower prices are no longer attractive, so companies scale back on their operations. And level six is demand for resources increase due to lower prices, and then cycle starts all over again. So that was a commodity cycle. In a nutshell, if it's the law of supply and demand, hopefully all of you know about it anyway. But the supply and demand basically at work on a much grander scale brings us to commodity cycle. So I think it is fair to ask, we mentioned how Canada and oil have a very close relationship, and oil has been pricing. So I think the fair question is, why are oil prices slumping? Why is this? And well, again, back to Paulo's speech, he attributed the falling oil prices to a sharp rise in supply, thanks to primarily to thanks to the technological advances in oil extraction everywhere. Paulo's also singled out the United States and its entry into the oil market, saying that oil output from the US essentially didn't exist before 2008, but it reached around 4.2 million barrels per day in 2014, which is roughly equivalent to all the oil that Canada produces in a year. Regarding the demand side of the equation, Paulo noted that the recent slowdown in China and the earlier slowdown in India both contributed to lower commodity prices, but both emerging economies are still an important source of demand now that both economies are growing at a more moderate yet sustainable pace. So you may ask, what is Bank of Canada doing about plummeting oil prices to sustain their economy? Well, the answer is that unfortunately, Bank of Canada cannot really do anything about it directly, since that is mostly up to the private sector. The private sector is still struggling to adjust to the supply shock, and these complex adjustments will take considerable time, but the Bank of Canada is doing what it can to help make the transition less painful, which includes the 2 rate cuts for this year and the BOC's accommodative stance on monetary policy that we've been seeing in the past few months. Paul has also pointed out that not interfering with the floating exchange rate, unlike other countries such as Switzerland, has allowed the loonie to depreciate in response to falling oil prices, reducing the deflationary pressure on the economy as a whole. The same policy of non-interference also apparently helped to avoid an overheating of the Canadian economy when the loonie went above parity to the US dollar due to oil surging from $25 to over $100 from 2002 to 2012. So if we were to say what is next for Canada and oil, Pauls was actually asked this question during his speech, and he didn't really have any forward guidance for Canada or the future direction of oil prices, saying that technological advances have historically made predictions very difficult, which I think is a cop out, but I digress. As an example, he cited the situation back in the 1970s when practically every pundit was saying that the world will run out of copper by the year 2000 due to its insatiable demand for copper wires. But fiber optic cables came along later, which made copper wires obsolete. Since Paulus didn't have anything to say about the future of oil prices, I'm gonna give my take instead. I don't know how deep this oil hole is gonna be, but I don't think we have seen the bottom quite yet, since there are currently a lot of events that could potentially increase the downside risks. For one, we have the Iran deal and its implications to the global oil supply is to worry about. Also, we mentioned before that Canada has been the main dealer of oil to the US, but the increased domestic oil production in the US will soon mean that the US will be getting high on its own supply, since its oil imports have been contracting at an alarming rate. Well, it's alarming only from Canada's perspective, obviously. Furthermore, the U.S. House of Representatives just recently passed a bill to repeal a ban on U.S. oil exports. It would still have to go through the Senate, but if the ban is repealed, then the U.S. could become a major player in the oil market as well. So Canada's primary customer could potentially end up being its competitor, which is going to be very bad for Canada and the Canadian dollar. All right, that was my output and intake on Canada and Canada's economy, oil, and Canadian dollar. Let's take a quick look at the Canada's chart versus the US dollar. Here is my Orbex platform, and I'm going to open the dollar CAD pair, picking it right from here. So here we have the dollar CAD, and as you can see, the market has been on the upside versus the US dollar. The US dollar has been rising versus the Canadian dollar, and right today we actually exited our position on dollar CAD at 133.40, which has been consolidating since after that happened. So one interesting thing that we need to know about Canadian dollar, hold on one second, I'm hoping that I can open a new chart over here. There you go. So back to the candlesticks for dollar CAD on the daily basis. Actually, let's go to the monthly basis because I want to show you how dollar CAD has been crossing above a saucer top pattern. We talked about this last week during our technical analysis session. So right here we had Canadian dollar crossing above the saucer top, which potentially has opened doors to further upside moves towards 1 40, and in extension we have the next extended previous bottom, but previous support turned into resistance at 144. So September has been, we had mostly consolidation in the dollar CAD pair, but today we saw the break above the neckline, and this could be an indication of further upside in the dollar CAD pair. All right, back to the presentation. Do we have any questions up until now? Welcome everybody, the new people joining us. We already covered Canadian dollar and the Canadian economy and what has been going on with them. Next, we are going to cover Europe. Europe has been in the markets, hasn't it? Right today we had major economic PMIs out of France, Germany, and Eurozone in general. Before that, we had Greece's elections over on Sunday. So I am going to talk a little bit about it before we get into other economic factors of Greece, of Euro. So while the Greek debt drama seemed to reach its happily ever after last month when the country managed to unlock its third bailout, the current government still had a lot to work to do when it comes to convincing the rest of the population to accept its fate. Recall that Tsipras, Greece's prime minister, and his Syriza buddies had been trying their very best to live up to their anti-austerity promises by playing hardball with Greece's creditors and calling for a nationwide referendum to reject more spending cuts. However, the IMF and other European lenders refused to back down as well, forcing the Greek government to accept harsher austerity measures in the end. Because of that, Tsipras doubted that he's basically the hero that Athens deserve, but not the one it needs right now. So he decided to put up for a vote because he can take it because he's a hero in his own words, right? Despite the opposition and criticism that Tsipras had faced even from within his own political party, the poll results revealed that majority of Greeks seem to be fine with the status quo, probably because they're worried that another change in government could bring about more financial chaos. After all, the standoff during the bailout negotiations earlier this year has resulted to strict capital controls, temporary bank closures, and bad days for businesses, a situation that they'd rather not go through again. That's what we think. So you might think, is it all good now? Is Greece out of the question? Not necessarily. Even if the Syriza party had been able to stay in the lead, they are still likely to fall short of securing majority of the 300-seat parliament. This means that a coalition government will have to be formed, with Tsipras likely to conduct negotiations with the other political parties to see who they'd like to share the stage with. Now, this could still prove to be crucial for the country's debt situation, as the coalition parties will have to be on the same page when it comes to implementing the austerity measures required in the bailout package. Keep in mind that an international review of Greece's progress on its economic reforms is due by the end of this year, and creditors can still close the taps on the 86 billion euro bailout program if they're not satisfied with the results. Now, the main question and the reason why we're interested in Greece is, will the euro be still affected by all this? Based on its forex price action the past few weeks, it looks like the euro has been able to move on from the Greek debt drama and focus on fundamentals and other market factors. In fact, the shared currency of the euro, drew a bit of the support from improving Eurozone data for quite some time, but soon erased its gains during the global stock market turmoil. And when ECB Governor Draghi shared that they're willing to ease further if necessary. So what's next is basically we have to watch out for what is coming up in the Eurozone. Taking a look at last month, what has been going on in Euro in terms of employment and other economic factors. Let's take a look actually. So since September, unemployment has gone down to 10.9%, lower than the previous month's 11.1%. So that is one green side. Employment change has been unchanged on the yearly basis, but on a quarterly basis, it has actually been up to 0.3% from previous quarter's 0.2%. So that is also in the green. We have unemployment rate statement again on Wednesday, September 30th. So that is something to look forward to if you are going to trade the euro. Another thing we want to take a look at is interest rates. How has the interest rates been going with the euro? The interest rates, the ECB, European Central Bank, has kept the interest rates unchanged for the past many months. If we look at the chart, so that is not something that is going to help us with the euro. Another thing that I do want to take a look at is industrial and non-industrial activity, as well as liquidity and balance and confidence indices. So in that terms, in the month of September, the market manufacturing PMI on September 1st came in slightly worse than expectations. However, the composite and services PMI came in slightly better than expectations, but not really affecting the market. This is the beginning of September. Then we had the industrial production on September 14th, so Monday, that jumped up from predictions of 0.6% to 1.9% higher than previous year. And also the monthly production, industrial production, also jumped from minus 0.3% to 0.6%, which was a very good news for the euro. The GDP, gross domestic product, came in better than expectations this quarter at 0.4%. The expectations were 0.3%. And the annual year-on-year GDP also grew to 1.5%, comparing to last year's 1.2% and the expectations of 1.2%. And in that sense, we saw growth in the economy. However, today we had the market services PMI and PMI composite. They both came in slightly lower than expectations. At 54, the expectation was 54.2, and last time we had it at 54.4. It is not a huge drop, and it actually was not able to drive the euro lower than yesterday. It actually has been bullish today, which is pretty ironic, despite the strength in the US dollar. If we take a look at the chart of euro dollar, let me bring it up on our forex platform. Oh, you are taking a look at this one right now. So we are showing this screen. Please actually let me know if you can see my screen. Type in Y for yes if you can see my screen, because I would like to show you the chart. As you can see, the market has mainly been consolidating actually after the massive drops that we had prior to the consolidation. Last month during the stock market, global stock market turmoil, we had a massive jump followed by a massive drop in the euro dollar, and since then it still is back to the range. Basically, it is right now, as you can see, it is right now testing a neckline of a potential double top. This is a advanced double top, the first top over here and the second top over here, and we are, for a further bearish indication in the euro, we would need a break below 110. We haven't got that yet, and the market actually corrected its downfalls from the previous 3 days. After the 3 black crows, we are seeing a correction. This could be a temporary correction, and if we do see a break below 110, that could in fact open doors for further drops to 1.08 area. All right, so back to our presentation. We already covered Canadian dollar, euro, and next we are going to take a review at Switzerland and see what is going on in the happiest place on earth. It was voted by the national happiness indicators. So let's see how the economy of Switzerland is doing. After it has been a while actually since Swissy has had a massive drop or gain for that matter. So let's take a look at an economic overview: growth, employment, consumer spending, sentiment and business sentiment, inflation, and I'll just sum it up for you that how it is going with the Switzerland. So starting with growth, after contracting by 0.2% back in Q1 2015, the Swiss economy managed to erase its earlier loss with a 0.2% expansion for Q2 in 2015. By doing so, the Swiss economy has just barely able to avoid a technical recession. In terms of a expenditure, the main contributors to keeping the Swiss economy supported were household spending, which is currently at 0.3%, better than the previous 0.2%. Government spending is lower at 0.2%, previously was at 0.3%, and the positive trade balance on goods due to imports is actually very low at minus 11.3%. Previously was at 2.7%. And this has been falling faster than exports, which is currently at minus 6.3%. Surprisingly enough, the main drag was a negative trade balance in services due to imports, which is now at 3.3%, lower than previous 0.6%. Greatly overtaking exports. Year on year, the Swiss economy only grew by around 1.2% for Q2 2015. Last year, it also grew at 1.2%. So it has been pretty stable, but not fast. An increase isn't always a good thing, and besides, the Swiss economy has been growing on an annualized basis for 22 consecutive months now, and that is a great thing in general. No wonder they are happy, right? In terms of employment, the jobless rate for August ticked higher to 3.2% from previous 3.1% due to an influx of new job seekers. Regionally, there is some regional work center or RIV reported that there are 192,669 job seekers for the month of August, which is 1,730 more than previous months. And the Swiss economy wasn't apparently able to absorb some of them because the number of unemployed people who are enrolled with RAV increased by 3,229, bringing the total number of unemployed persons to 136,983. So that is not entirely great for the Swiss economy. As far as consumer spending and sentiment, as I mentioned earlier, consumer or household spending has been a major factor in keeping the Swiss economy afloat. But what about the more recent data? They actually don't look too good, since consumer confidence in July plummeted to minus 19 from June's minus 6. And if we look at the components of the report, consumer expectations with regard to future economic development sank like a rock to minus 25 from minus 8 previously. And it also looks like the Swiss are growing more pessimistic with regards to their current financial situation. But it seems like they are still not afraid to spend on major purchases such as cars or homes if they really have to. The poor consumer sentiment was reflected on the retail sales data for July, since the seasonally adjusted reading slumped by 0.6% month on month after increasing by 1.4% previously, which is definitely a bad starter for Q3 GDP. Apparently, the main drag was lower demand for non-food items, excluding fuel, since the retail sales value decreased by 0.9% on a monthly basis. On a slightly more upbeat note, the year-on-year reading shows that the retail sales is still in the red, but it's steadily clawing its way back up after dropping hard back in May of 2015. Now let's move on to business sentiment. The ordinary Swiss consumer may not be all that happy because but the business is good in Switzerland, since the KOF Swiss Economic Institute Economic Barometer ticks slightly higher to 100.7 in August from 100.4 previously. The overall optimism is due to positive tendencies in the banking and manufacturing sectors, although the construction sector seems to be holding some negative sentiment. And if you're new to forex trading, the KOF Economic Barometer is a leading indicator for Swiss economy, comprised of 217 indicator variables. It is meant to forecast the development of the Swiss business cycle. It also practically acts as a gauge for business confidence, since it is mostly incorporates indicators from the business sector. Moving on, Credit Suisse manufacturing PMI shows that the Swiss manufacturing sector expanded in August from 48.7 to 52.2. And things would probably get better for business, since the ZOO economic sentiment indicator posted a 3.8 points increase, propelling September's reading to 9.7 points, which is the highest reading since March 2014. All right, so we have some good news for Swiss. Inflation, in terms of inflation, Switzerland is still suffering from poor inflation levels, and while the month-on-month reading for August seems slightly upbeat, it is currently at minus 0.2%. It used to be, well, the previous reading was at minus 0.6%. But despite that, the yearly reading actually shows that the intensifying deflationary trends is back. It is currently at minus 1.4%, whereas last year it was minus 1.35%. It is a slight decrease. The main drags to the dismal annuals reading were declining prices for food, energy, health services, and transportation. So overall, the Swiss economy isn't really doing that well, but then again, the main driver of the Swiss forex price action is usually risk sentiment. Forex traders flee to the Swiss sea during times of uncertainty and dump it when risk of appetite is high. And that is basically the reason why we've been seeing the recent down moves on Swiss franc versus the US dollar. Still, forex traders did buy up the Swiss across the board as likely a response to S&P optimistic statement that it expects economic activity to pick up gradually in the second half of the year. So, um, perhaps some longer term forex traders are looking at the fundamentals. In any case, it seems like demand for the safe haven Swiss may be picking up again in the longer term, especially if risk aversion make a comeback. Especially after the U.S. Fed's recent decision to keep the rates on hold. But actually, let's take a look at the Swiss franc on our charts. Show the application. Please let me know if you can not see the application. I have opened my Orex platform to show you the Swiss franc. So what has been going on? It has been ranging after the massive drop that we saw at the beginning of the year. It's the dollar Swissy basically recovered from all of the drops until March, and then it has been ranging basically within the support levels of 0.98, and this one is actually a trend. So this has been the support level for Swissy, and we have had 4 consecutive upward moves for the Swissy. I currently am in a bullish trade for dollar Swissy, targeting 0.9830, and a break above that would bring us back to the next target at 0.9890 or 99. But this level at 0.98 is pretty strong, because as you can see, the pair has tested it a crazy amount of times before. Once back in March, then again over here, then again over here, and then again over here is now testing it. So a break above it would definitely open doors to further up moves to 0.98, especially since, as we just overviewed, the Swiss economy is not doing that great. So chances are, if we don't see another global turmoil or Chinese shock or any other kind of, I don't know, world war or something, we could see the range to continue. So that could be a good opportunity for range traders. All right. Let's go back to our presentation and cover our next country. Today, the next country we're going to talk about is the UK. Let's see what has been going on. So, the UK has been interesting because they have continued to give us mixed signals. Let's actually just take a look at what has been going on with the UK in the past let's say 2 months. We're going to take a look from beginning of August until now. So in terms of employment, in August we had better than expected employment, followed by better than expected unemployment rate in September. It is currently at 5.5 versus last month's 5.6%. The climate change has dropped actually to 1.2K, which is not a good thing, comparing to last month's minus 4.9K. So in terms of unemployment, it seems like overall, if you look at all the components of unemployment claims and the claimant count, it has been growing steadily, so not that bad in terms of unemployment. In terms of confidence indices, the consumer confidence is actually due on September 28th. Last month, the consumer confidence in the UK was actually higher, much higher than the previous months and the expectations of 4. Last month we had it at 7, and a drop in next week's consumer confidence could actually move the British pound to the downside. Let's take a look at other industrial activities, consumption, inflation, interest rates, liquidity, and balance. So, all right, so we're going again back to August. The market PMI for August was higher than expected, while the PMI for July dropped again. Then we had the PMI for August released in September coming in again lower than expectations at 51.5 versus the 52 expected, and the previous month's 51.9. The PMI construction also dropped to 57.3 from the previous from the expected 57.5. However, it did grow from the previous months. The market services also dropped to 55.6, both versus the expectations and the previous months. We are expecting the next PMI to come out in October, so that could potentially create volatility in the British pound. As far as industrial production goes, so in the month of September, the manufacturing production dropped to minus 0.8% from last month's 0.2%. The industrial production dropped as well. It didn't drop actually. It stayed steady at minus 0.4%, but it was lower than the expected growth of 0.1%. The year-on-year production, however, did drop both versus the expectations and the previous year. It is currently at 0.8%. Last year it was at 1.5%. So that is a big drop for industrial productions. Manufacturing productions on the year-on-year also dropped to minus 0.5% from positive 0.5%. So that was also a massive drop. As far as the PPI, Producer Price Index, goes, this also has been in the red. The core consumer price index has been steady. And one last thing that I do want to take a look at is the retail sales. It also came in lower on a year-on-year perspective at 3.7% versus last year's 4.1%. However, on the monthly basis, this has been growing a little bit from 0.1% up to 0.2%. The public sector net borrowing has also increased by a huge amount. So these are not good stories in general for the British pound when it comes to fundamental data. Also, something that we would want to keep in mind is that, well, Mario Draghi actually mentioned it in an update yesterday on Investiva. Mario Draghi was pretty upbeat about the economy in his previous statement. However, we are now seeing that they are not as excited, and they are actually willing. I'm sorry, I said Mario Draghi. I meant Bank of England's economists. They were talking about a potential rate hike in Britain previously, but now suddenly they have told us that they may have to cut the interest rates, which are already on a record low levels. And this highlights signs that the global economy is on the edge of disaster and entering its third phase of turmoil. Mr. Carney, we are waiting for his statement soon to see what he really thinks about the British pound, and if he was really serious about what he said about cutting interest rates. In the past 4 or 5 days, we have seen the British pound dropping massively, erasing all the gains that they have. Let me actually show you the chart. The pound so for this, we're back to Orbex's platform, and as you can see, the pound has been dropping in the past 4 days, erasing almost all the gains that it had in the previous weeks. But again, if we take a look at a bigger scale, the British pound also is kind of ranging at the moment after touching the bottom of 1.45, and right now it's currently actually marching back to a key support level of 1.51. With this drops that we were seeing, if it is able to break below this level, then that is pretty bad news for the pound versus the dollar, because that would open doors for further drops with 1.49 as an extended target. So right now, actually, if you're not already in a bearish position at the pound dollar, I don't recommend that getting in it is a good time right now, because we're very close to reaching the 151 level, and after that we may actually see a correction. If the pair does break below it, then that is a good time to get on with the trend and aim further drops to 1.4950. All right, people, we are actually done. It is now time for questions. If you have, I am more than happy to answer it. I actually did see a rise of a hand. I'm trying to get it actually. Somebody raise their hand. If you have a question, please just write it down in the chat box and we'll pop up in the question box. As always, let me again go back to our presentation. Unfortunately, we didn't have time to cover Australia, US, and New Zealand. but definitely if you do sign up for Investiva's commentary on investiva.com, we're more than happy to send you our free um, daily market analysis. If you would, all right, I have a question from Said Rafael. Shall we sell the dollar pound? It's actually pound dollar, right? So the pound dollar, if you're already in a bearish position, you should remain and target 151.70. If you're not, wait for a confirmation of a break below 151 right over here, and if it does confirm a break below this level, then you can get into a bearish position for the British pound versus the US dollar. Otherwise, right now, after all these consecutive days of fall, after reaching 151, if it's not able to break below it, we could see a correction actually back up. So for that, you should actually basically be stay tuned and definitely watch out for either my videos on orbix.com or our daily updates on Investiva. Let's go back to the presentation. Here is Orbix, info at orbix.com is where they would answer your questions about this webinar. This webinar was recorded. It was a 1-hour webinar. I did see a lot of people joining us in the second half of the webinar. So if you would like to get my review on Canada and Euro, definitely go ahead and check the recorded material. As for myself, as I mentioned before, feel free to sign up on investiva.com for our daily updates for a one-on-one webinar with myself if you would like to show me your trading skills or trading strategies, and if you want to discuss your account, discuss your trades, definitely sign up for a private lesson on investiva.com. If you are in the US, Stamford, Connecticut area, I am having a book signing in Stamford on October 10th. So you can pin that in and come see me personally in the Barnes and Nobles in downtown Stamford. All right, everybody. Thank you so much for joining us, and I hope to see you again in our next webinar.